Hey guys, in this video let's compare some of the most popular international dividend ETFs. International equities have been grabbing investors' attention due to their recent outperformance. Since the beginning of the year, foreign equities ETFs outperformed their US counterparts. The US dollar depreciation has been the biggest factor behind it. For this video, I will focus on three funds. The first one is SCHY by Schwab and the second one is VYMI by Vanguard. But I also want to throw another fund into the mix, and that is LVHI by Franklin Templeton. This fund is somewhat different compared to the other two. Let's start with a summary table for the three ETFs. All three funds are passive and track underlying indices. While we will cover much of this info shortly, I want to draw your attention to a few areas. The first thing is that LVHI is the most expensive of the three with a fee of 0.4%. Returns vary, but fees are always subtracted. The difference of 0.2 or 0.3% may not be that significant if a given fund generates strong total returns. Morningstar classifies these funds in the foreign large value category. The average expense ratio for this category is roughly 1% in 2025. So all three funds charge much lower fees, especially SCHI. Another thing is that of these three funds, LVHI does not invest in emerging markets. And emerging markets tend to show higher variation in returns. Also, emerging markets are less correlated to US stocks compared to developed markets. Since 2021, exposure to countries like China was a drag on performance. After peaking, China-focused funds are still far from their full recovery. Depending on your preferences for emerging markets exposure, LVHI may or may not be a good fit for you. Also, LVHI hedges foreign currency fluctuations against the US dollar. When the US dollar depreciates, like it did in 2025, this hurts LVHI relative returns, keeping other things constant. Conversely, dollar depreciation helps SCHI and VYMI do better. Long-term foreign currency fluctuations may not matter according to Morningstar. They tend to wash out. But sometimes that can help. From 2010 to 2024, the US dollar has appreciated by over 30%. That was a big contributing factor behind better relative performance of hedged international funds. True, hedging currency risks helps LVHI to reduce its volatility, but it also removes a valuable source of diversification. If diversification was my goal, this is something not to like about LVHI. Next, let's look at how each fund constructs its portfolio. And let's start with SCHI. If you're familiar with the other dividend fund by Schwab called SCHD, the construction of portfolio for SCHI will follow a very similar methodology. The fund tracks the performance of the Dow Jones International Dividend 100 Index. The index focuses on stocks that pay dividends with consistent growth. SCHI excludes US stocks as well as real estate investment trusts. After applying liquidity filters, SCHI selects stocks with 10+ years of paying dividends. It's a very stringent rule and it eliminates a large number of stocks. And if a given company misses even one dividend payment, it will have to wait another 10 years just to pop up on SCHI's radar. But at the same time, this rule makes sure that SCHI's holdings have a 100% commitment to dividends. But that's not all. Like SCHD, SCHI applies more filters based on 4 financial metrics. These are free cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. This ensures that the selected companies are profitable. It also weeds out companies with excessive debt load and leverage. And at the same time, it focuses on companies with consistent and growing dividends. And finally, SCHI ranks companies based on their standard deviation of returns, and it only selects stocks that showed volatility that is below their group median. The last filter is important because stocks with lower volatility tend to be more defensive in nature. Also, they are more likely to show smaller drawdowns in market downturns. Next is VYMI. The fund uses a simple but very effective approach when it comes to maximizing yield. The fund looks at both emerging and developed markets, omitting US stocks and REITs. One of the main requirements for VYMI is the exclusion of stocks that don't expect to pay dividends in the next year. But other than this rule, anything goes. VYMI ranks its candidates based on expected dividend yield. The ones in the top 50% land in VYMI portfolio. The fund holds over 1,600 stocks in its portfolio on a given day. Finally, there's LVHI by Franklin Templeton. The fund starts with stocks in the MSCI World excluding US local index. The index excludes emerging markets and US stocks. So LVHI is 100% focused on developed markets. LVHI screens stocks with profitability over the last year. Unprofitable companies get dropped out. Also, a given stock must have paid or expect to pay dividends. Next, what follows is a series of filters. The fund ranks companies based on a few factors. These are volatility of stock prices and volatility of earnings. The fund also applies another interesting filter. It ranks stocks based on their country's interest rate. Finally, LVHI looks and ranks stocks based on foreign tax rates on dividends. Similar to SCHI, stocks with higher volatility will receive a lower ranking in LVHI portfolio, and this again promotes those defensive stocks. Also, stocks that showed high volatility in earnings will also receive lower rankings. Again, that's understandable. Variability in earnings can signal worse outcomes for dividends and their growth. But the last filter on interest rates is something I had to wrap my head around. Basically, LVHI demotes stocks from countries with relatively higher interest rates. Why would it do that? I can only speculate, but higher interest rates can mean higher cost of debt for companies which have debt. Also, higher interest rates can signal overheated economies, high inflation, or something else. But overall, it's very rare to see an equity fund that uses macroeconomic indicators to select its stocks. When it comes to the number of holdings, VYMI is the most diversified with over 1,600 names in its portfolio. The top 10 concentration is also quite low at 14%. VYMI holds many solid foreign names like Nestle, Novartis, and Toyota. I have one concern over VYMI casting such a wide net over dividend-paying stocks in foreign markets, and that is that it will end up holding a bunch of value traps. And value traps look great and promising on paper. They're cheap with great potential. But they're cheap for a reason. Usually they may have deteriorating fundamentals and they may experience price declines. And if things come to worse, they may even cut their dividends. But the good news is that VYMI weights its holdings by market capitalization. And this approach promotes and emphasizes large and stable companies. At the same time, if, let's say, a given stock turns into a value trap and it will start to decline relative to its peers in terms of market capitalization, in that case, VYMI will start to de-emphasize this value trap stock and allocate less funds to it over time. As for SCHI, it's the most top-heavy fund of the three with 40% allocation for top 10 stocks. Due to strict selection rules, few stocks eventually make it there. In fact, its top 10 allocation would have been much higher if not for caps and limits. SCHI applies 4% cap on individual stock and 15% limit on sector exposure. Caps and limits do help with diversification, but they may introduce unnecessary rebalancing from time to time. Also, sometimes stocks in SCHI's portfolio may stop satisfying its strict rules, and in that case SCHI will have to drop it and reconstitute its portfolio by trading more. Last year SCHI's turnover was 59%, and in other words, the fund had to replace 59% of its portfolio with something else. But higher turnover means more trading and higher transaction cost for a given fund. And in the case of SCHI, with its strict rules, unfortunately it looks like it's a necessary evil. And here's the problem. Turnover trading costs are not reflected in funds' expense ratios. That's right, expense ratios only cover management, consulting, accounting, legal, and some other operating expenses. So, in other words, trading costs due to high turnover still get subtracted from the fund's net asset value either way. Lots of trading and turnover entails transaction costs, and these transaction costs will eventually eat into the fund's total returns. And it's like a hidden cost that the investors are not aware of as they focus solely on expense ratios of a given fund. You may wonder why I'm making such a big deal out of it. The thing is that there were some attempts to estimate these turnover transaction costs. John Bogle, the founder of Vanguard, published an article on this back in 2014. There, he mentions that the annual trading cost from funds turnover trading could be over 1% a year. That's a lot of hidden cost. 1% can compound and snowball into a big number over decades. Let's come back to SCHI and its caps and limits. The thing is that limits can actually backfire and prevent SCHI from taking advantage of its strong performing stocks. Let's say there's a stock that performs very well relative to its peers, and its allocation grows in excess of 4%. SCHI must rebalance and reduce its exposure to these stocks below 4%. But what if these strong performing stocks continue outperforming its peers? Well, in that case, SCHI will not be able to take full advantage of their stronger performance. In fact, LVHI does a similar thing. It's even more restrictive with a 2.5% cap on individual stocks. Its top concentration at 24% is artificially capped. Unlike VYMI and SCHI, LVHI does not use market cap weighting. Instead, it uses its own proprietary weight rules. Also, LVHI has the highest turnover ratio of 93% of the three funds. That's a lot of turnover trading costs that get subtracted from your returns every year. And that's on top of 0.4% expense ratio LVHI charges. In comparison, VYMI may look more appealing with market cap weighting and no caps or limits. The fund naturally goes where markets go and harnesses their collective wisdom. Its approach is simple and very effective, and with many stocks in its portfolio, VYMI top 10 concentration is the lowest at 14%. Also, its turnover ratio is the lowest at 11%. So even though VYMI expense ratio of 0.17% is higher than SCHI, VYMI does not have to do a lot of turnover trading. Hence, VYMI does not incur too much trading costs. When it comes to sector allocation, VYMI is the most concentrated one. Its allocation to the financial sector stands at 41%. SCHI and LVHI have a more even exposure across different sectors. Again, caps and limits play a role here. SCHI places 15% cap on sector exposure. LVHI has 25% exposure limit. So no wonder that their sector exposure stops short of these numbers. Conversely, VYMI has no caps or limits on sector exposures. So is this high allocation to one sector a concern for VYMI? Well, we know that VYMI goes where markets go when it comes to dividend yield. And so, as it happened, there are more high-yielding stocks in the financial sector like banks or asset management companies. And so, naturally, VYMI allocates more to these stocks. But either way, it's a concern, and it's something that VYMI investors should be aware of and be willing to live with. Next, let's take a look at country and regional allocations. Be aware that these are the snapshots in time, and so these numbers can change over time. Both SCHI and LVHI allocate most money to developed Europe. VYMI also has a sizable and the largest allocation to developed Europe, but its other allocations are more evenly distributed. On top of it, VYMI has the largest allocation to emerging markets at roughly 18%. SCHI comes second with 14%. As for LVHI, it comes with no exposure to emerging markets. When it comes to country exposure, neither of the funds look particularly concentrated, although keep in mind that LVHI imposes a 15% cap on individual country exposure. Top 5 countries look more or less similar. VYMI allocates most to Japan. Japan does have many high-yielding conglomerates and trading houses like Mitsubishi. The next thing is dividends. If we compare dividend growth rates, SCHI is the most consistent grower of the three. If we discard the first year, its last 2 years saw impressive growth rates. VYMI also showed dividend growth, but at a lower clip. Conversely, LVHI was the least attractive of the three. Its dividend growth is all over the place with a notable decline in 2024. Part of it has to do with those filters and rules that LVHI applies. It emphasizes stocks with lower volatility and less earnings variability. And so this likely has produced that dividend growth fluctuations. So for people hoping to rely on LVHI dividends in their retirement, this is bad news. One thing that I'm personally curious about and would like to know is how would SCHI fare during 2020 and 2021 COVID episode? The fund started trading in 2021, so there's no point of comparison. We see that VYMI's dividends declined big time in 2020 due to COVID shock. Many companies cancelled or lowered their dividends due to financial strain. I wonder if the same thing would have happened to SCHI. But at the same time, we know that SCHI prioritizes consistent dividend growth. So there's some chance that SCHI would have done better compared to VYMI and would not experience declines in its dividend growth. My take is that SCHI will likely show a higher growth in its dividends, but I'm not sure that VYMI will be too far behind. Its unconstrained focus on dividend stocks will make sure that its yield on cost will also show consistent growth. Next, let's take a look at total returns. Dividends are only one part of the equation. Let's choose 2021 as our starting point when all three funds were operational. And here we see that LVHI outpaced the other two dividend ETFs. SCHI has been the biggest laggard. Is this surprising? SCHI prioritizes defensive companies that can fall behind other funds in bull markets. SCHI has to make sacrifices elsewhere by focusing on dividend growth and consistency. And that elsewhere is the choice of companies with lower price appreciation potential. As we see, LVHI did much better. I attribute this better performance to several factors. The first one is that developed markets outperformed emerging ones over the last, let's say, 5 years. That outperformance was more than 2 times, so undoubtedly this helped LVHI. But let's zoom out and observe our total returns graph since 2016. Here we see that the total returns difference between LVHI and VYMI is not so big anymore. One of the factors at play here is the appreciating US dollar. Since 2016, the US dollar has grown stronger against foreign currencies. This has subtracted from VYMI's performance compared to LVHI. It's not clear by how much. The US dollar index shows on average 10% appreciation since 2016. So this can partly explain the return differential between VYMI and LVHI. If the US dollar appreciation trend reverses, VYMI will likely do better. In fact, since January, this is what helped VYMI and even SCHI to outperform LVHI. If we look further at volatility adjusted returns, we see that LVHI stands tall. Its total returns have been high, but its volatility as measured by standard deviation has been low too. This produced a much higher Sharpe ratio for 3 and 5 year time horizons. LVHI places great emphasis on constructing a low volatility portfolio. Hence, its low standard deviation does not come as a surprise. As we know, SCHI also focuses on low volatility stocks, but the fund does not place as much emphasis on it as LVHI does. For this reason, its standard deviation was a bit lower than VYMI, but it wasn't as low as for LVHI. Also, if we look at the recent drawdown episode in 2022, LVHI max drawdown of 10% stands tall too. As for SCHI, it declined by over 17%, which was only 1% less compared to VYMI. Finally, I want to point out that all three funds have pretty low overlap, ranging from 15 to 25%. But this doesn't necessarily mean that it is worth combining them in one portfolio. Also, among the three funds, LVHI tends to tilt most towards value. This can partly explain why LVHI commands a somewhat higher dividend yield at the moment. But again, this may not translate into consistent dividend growth down the road. So with that, let's recap what we have seen so far. And the goal is to see which fund suits best different investors' preferences. Let's start with SCHI. The current SCHI yield is the lowest of the three, but the fund comes with a focus on consistent dividend growth and quality, so there's a high chance that SCHI dividends will grow faster compared to other funds. But SCHI applies very stringent rules and filters. This leaves it with very few candidates to pick from. Its 10-year history of dividends requirement is especially notable, as SCHY's portfolio gets very top-heavy for this reason. As a result, the fund management has to apply caps and limits. True, diversification improves, but it comes at a cost. The fund has to do more rebalancing. This can hamstring its top performers. Also, when it comes to total returns, SCHY is very likely to lag behind the other two funds. This is especially true in bull markets. SCHY selects quality stocks that show lower price appreciation in economic uptrends. While dividends do matter, it may not be worth it to trade higher yield for lower total returns. And it's not like SCHY is any better in terms of volatility or drawdowns compared to VYMI. Next is LVHI. This fund is an interesting case. It does command the highest yield of the three, but its dividend growth is inconsistent. It's hard to say why. I speculate that it's likely due to how LVHI places a lot of emphasis on low volatility stocks. LVHI's portfolio turnover ratio of 93% is staggering. Every year, this fund has to replace almost all its holdings. This can be the main factor behind inconsistent dividend growth, but more importantly, it can lead to a lot of turnover trading costs. These costs are subtracted from your returns. And don't forget hedging the currency risks. It's not exactly costless and also comes along with trading costs. And that's on top of LVHI's expense ratio of 0.4%, which is the highest of the three funds. On the flip side, the fund produced much better total returns since its inception, although it was not materially higher compared to VYMI. A lot of it has to do with the appreciating US dollar over the last 10 or so years. LVHI hedges foreign currency fluctuations. Thus, it does relatively better when the dollar gets stronger. True, hedging currency risks can dampen volatility of returns, but at the same time, it can eliminate a valuable source of diversification. For example, lately US dollar depreciation helped VYMI and SCHI, but at the end of the day, it's a personal choice to pick hedged or unhedged fund. Finally, you must consider that LVHI excludes emerging markets. And true, developed markets did better than emerging ones. But these trends tend to change. And so, depending on your preferences, which market exposure you want to have, you would prefer one over the other. And finally, VYMI. This fund stands out among the three funds with many things. It has no constraints over stock, sector, or country allocations. It goes where the stock market goes when it comes to high-yield foreign equities. Because it holds many stocks with buffers, its turnover is many times lower than its rivals. With that comes less trading and smaller transaction costs. VYMI has shown robust dividend growth with COVID episode aside. Its yield on cost has been growing too over the past 10 or so years. Since 2016, its yield on cost increased from roughly 4% to 6%. It is possible VYMI's dividend growth may not match that of SCHI long term, but the fund showed stronger price appreciation compared to SCHI. True, LVHI still did better than VYMI on a total return basis. VYMI's exposure to emerging markets and foreign currencies were negatives during the comparison period. But these trends come and go, and VYMI comes with fewer rules and restrictions when it comes to selecting high-yielding stocks. And sometimes simpler approach is the best one and may work wonders long-term, as John Bogle liked to emphasize. And that's it for this video. I know it's a lot to digest, but I hope it will give you some food for thought and you will make more informed decision in regards to these funds. Also, please give this video a like, it means a lot to me. Also, if you have any suggestions in terms of future topics for my videos, leave a comment below. This particular video is a suggestion from one of my subscribers and supporters on Patreon. I really appreciate his support and recommendation. With that, subscribe to my channel for more content on investing and other economic topics. All the best!